October was another tough month for tenants, with rising rents, lower vacancy rates, and there's little relief in sight for the chronic shortage of rental accommodation, as Dr. Andrew Wilson and I discuss in this week's Property Insider chat. We also talk about the latest building approvals, retail spending, and how our auction markets fared over the Cup weekend. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so you can be updated each time a new show comes out. It seems only a year ago, almost everyone agreed high interest rates would stifle our property markets, and some even talked about a recession in Australia. And it was much the same for overseas economies, where recession talk abounded. Now, even as wars rage and geopolitical climate darkens, the world economy seems to have even the optimists confounded. America's economy roared in the third quarter, and around the world, inflation seems to be falling, unemployment's mostly stayed low, and the big central banks may have stopped their monetary tightening. Back home here, our economy's remained stronger than the Reserve Bank had hoped for in its fight against inflation, and our property markets have enjoyed 10 consecutive months of growth of property values. At the same time, rents have skyrocketed on the back of historically low vacancy rates. So in today's Property Insider chat, I'd like to talk with Dr. Andrew Wilson, Chief Economist of My Housing Market, and get an update on our rental markets. And we're also going to look at some of the latest economic data to give us some clues as to what's ahead for our housing markets. Hi, Andrew.
Yes, Michael, it certainly has been an interesting year, and we're coming to the end of what has been, I guess, a year of changed forecasts in terms of the economy and particularly the housing market. I think we can live to a certain degree with those hysterical headlines, the clickbait and the attention seeking, but I think it's important that our policymakers differentiate between the doom and gloom headlines and what their policy positions are. I think Australia's probably got caught a little bit with having too much of a negative view of the impact of interest rates. Although we're looking at other overseas markets, overseas economies, they're certainly improved compared to Australia. The US, as example, has an official interest rate almost 1% higher than ours, and yet its inflation rate is more than 1% lower than ours. So just on that comparison, perhaps we went into pause mode a little bit too early, and maybe we're going to pay the price with higher rates going forward. But that's another story. But certainly global economies and Australia's economies performing very well.
Back home, our rental markets have experienced historically low vacancy rates and skyrocketing rents. And your latest My Housing Market October rental report suggests it's been another tough month for tenants, Andrew.
We've had an interesting last 2 or 3 months in the rental market, Michael, I guess reflecting seasonal impacts. The August market was considerably tighter, if we remember going back there. I think that was a reflection of the beginning of the second part of the tertiary year. We had a lot of demand, particularly from students. We know we've had a lot of international students coming into Australia, so perhaps that was the reason for the tightening of our rental markets, already tight rental markets, tightening even further over August. September, we saw a bounce back, an improvement last month in vacancy rates actually rose, and there was some easing in rents, but I think that was just an adjustment from what was a very tight August, and we're back to, I guess, the normal position over October, which was just, yes, as you mentioned, Michael, another tough month for tenants. Vacancy rates generally fell again, adjusting, I guess, from the tight period in the middle of the year, and asking rents, particularly for houses, continue to rise. We're not seeing any sign of an improvement in our rental markets. If anything, we're likely to see perhaps more upward pressure on rents if we do get an interest rate increase from the Reserve Bank in the near term, because landlords will clearly be motivated to increase rents to offset any likely higher mortgage costs. But when we look at the data in some detail, Michael, Sydney's house rents were flat over the month, but they still remain clearly the highest of all the capital cities at $750 a week, pushing $200 a week ahead of Melbourne at $570. Melbourne house rents actually eased slightly, down by 0.9%, but only Melbourne and Darwin recorded lower rents over the month. Canberra was steady, similar to Sydney, but other capitals recorded higher rents. Perth was the leader, up by 2.5% over the month for house rents. Brisbane up 2.1%. We've really seen a surge in Brisbane house rents over the last couple of months, Michael. There's a continuing undersupply of rental properties, particularly houses in Brisbane, and that's certainly putting upward pressure on rents in that capital. And rents are now well over $600 a week, house rents, median house rents in Brisbane. So upward pressure continues on rents after some easing in the middle of the year. When we look at the annual results, they're still extremely high. Sydney rents up by 15.4% over the year. Melbourne up 16.3% for house rents. Brisbane up 11.4%, Adelaide up 12.5%, and Perth up 13.9%. The major capitals are reporting very strong growth in house rents over the past year. And all vacancy rates, with the exception of Canberra, are at or below 1%. And only Hobart is at 1% currently. And the other capitals, with the exception of Canberra, are all well below 1%. We look at Adelaide and Perth, they have vacancy rates of just 0.3% and 0.4%, Michael. So not good news there if you're looking for a property to rent, a house to rent in most of the major capitals, with continuing shortage of supply and continuing upward pressure on rents. And I think the only thing that's really stopping rental growth is the capacity of tenants to find those extra dollars to secure a rental property, because they're just waiting for their incomes to catch up with rental growth. If we look at unit rents, a bit of a better story for unit rents, Michael, over October. Sydney again flat, but rents for units are the same as houses at $750 a week. Melbourne also was flat in terms of the change over October compared to September, but Brisbane, again, another sharp increase in unit rents, up by 1.7%, and that was the leader of the capital cities in terms of rental growth. Brisbane unit rents are now at $600 a week. That's the second most expensive of all the capital city median unit rents. Adelaide and Perth were flat over the month. Hobart shifted downwards again, down by 3.3%, and Darwin and Canberra up marginally. Hobart's now the most affordable of the capitals for unit rents at $435 a week. But we look at, again, the annual results. Sydney unit rents up just under 30% over the year. Melbourne up 22.9%, Brisbane up 20%, and most of the capitals recorded strong growth over the past year for unit rents, with Canberra the exception, up by just 0.5%, and Hobart going the other way, down by 4.9% over the year. Vacancy rates for units are a little higher than houses. We have Hobart vacancy rates at 2%, reflecting, of course, those lower rental outcome we've seen recently. Sydney, Brisbane and Adelaide are still below 1%, and Perth as well. So perhaps more choices in units, Michael, in terms of accommodation for tenants, but still very, very tight, and still upward pressure on rents for units. And as I said, we just need more supply to offset this chronic shortage of rental properties that we have, whether that's new supply or supply from more established investors. But we're certainly basically run out of rental properties, particularly houses, in most of our capital city markets.
Well, as we've said a few times each week as we discuss these factors, that investors are slowly leaving the market as they're a bit more concerned about the continual interference with the government, rising interest rates and uncertainty about the future. So we look at building approvals to see, well, what's ahead, what's in the pipeline. And the September figures that came out last week are a little bit disappointing.
Yes, Michael, it's again, it's up, down with that ABS data, which we've discussed. Concerns about the seasonal adjustment models of the ABS. It's still coming to terms with the changes that occurred through COVID. That'll take some time to work through the system, when, of course, it was turned upside down, the seasonal adjustment modelling. So we are seeing this roller coaster from month to month. Of course, we had rises last month, but September's been another fall, down by 4.6%, following that 7% rise in August. Volatile units were down 5.1%. Houses were down 4.6%. Queensland was the top performer, up by 34.6%. When we look at the trend data, it's continuing to fall, Michael, rather than seeing any even bottoming out of trend growth in building approvals, well down on where it was a year ago for national home building approvals. And when we look at the charts, that reinforces that, not just the monthly falls in houses, units and the total, but also we're well down over the year to date compared to the same period last year, and the full year to September versus the full year to September 2022. And the big picture is, when we look at the capital city markets, capital city home building approvals are now down 36.5%. And these are annual trends. The annual trend is now down 36%. 6.5% compared to the peak back in 2015-16. A remarkable collapse in new building coming into new dwellings into our markets, our capital city markets, and that's despite that big surge that we had through that home builder policy of the previous government through COVID. And when we break down the trend into houses and units, we can see units are the big losers in terms of declines. Unit building trend is down 52.3%, Michael, since that peak in 2016. So we know that's the problem. We keep sort of saying the same stuff every month as the approvals come out, but there's really no relief in sight. This will only continue to put upward pressure on prices and rents. And Brisbane's the only most positive results over the year to September versus the year to September last year, with building approvals or dwelling approvals down by just 0.1%. But the other major capitals have all basically collapsed, particularly Sydney and Melbourne, in terms of home building approvals to the year so far compared to the same period last year. And Melbourne remains the big provider of housing, but these numbers are still recessed, as we saw, compared to previous years. Sydney is now starting to catch up with Melbourne. In fact, it exceeded Melbourne over the year to September compared to the same period last year in terms of unit development. So Sydney's picked up in terms of unit development, but Sydney still builds around about half or approves around about half the number of houses that Melbourne does. So we all know Sydney is that high-rise market, so that's reinforcing it in terms of that underdevelopment for houses.
Andrew, it seems that the pressure on our housing market is coming from a combination of a rapid rebuilding of our population. It suggests that the population is back to pre-pandemic trend where we would have been if there wasn't that closing of our borders. And the Reserve Bank suggested there's a pandemic-induced change in housing preferences. There's fewer people per household, which just on its own would suggest we need 120,000 new dwellings for the same population. But moving forward, despite the lower number of building approvals, as we've shown and your charts in the past have clearly shown, just because we're getting building approvals doesn't mean they're coming out of the ground, because currently developers just can't make all those new projects viable. So the bottom line is there's no end in sight to the rental shortage or a housing market shortage. I guess that's going to underpin our housing markets despite higher interest rates and all the other challenges.
Yeah, look, that's absolutely right, Michael. There's just no sign that we're even bottoming out, much less improving our position. The trend in declining building approvals, not being able to match, our demand, has been going back some years, and it certainly predates the COVID environment. We can look at the overseas experience, and similar jurisdictions are going through the same problem with being unable to match supply with demand, and particularly very high rents. It is all about the inability to match supply with demand through all those factors that we discuss. And these are systemic problems, Michael, and I'm not sure we've got any way of fixing it, to be quite honest.
Now, the Reserve Bank takes into account lots of factors when it decides what to do with interest rates. Despite higher interest rates and the higher cost of living affecting many households, last week it also showed that retail volumes rose.
We had a strong month for retail sales. There's been a lot of talking down of retail spending, Michael, which is, to me, becomes a little questionable, because even though retail sales trend has fallen, the ABS seems to be keen to talk down retail spending. The fact that the trend is, in their words, the lowest on record, and that's the trend of the trend growth, the point seems to be lacking in terms of that analysis, the context of it all. We've come through our strongest trend growth ever in retail sales because of COVID and the spending that occurred, which was designed and a good thing because we needed to inflate our economy. We overinflated it, of course, but that's another story. It's the party after the hangover after the party. The point was that another rise of 0.9%, which was the strongest growth rate since the beginning of the year, monthly growth rate, shows that we're still tracking retail sales at the highest levels on record. And of course, the trend is falling because we had a massive growth through the COVID spendathon. We're always going to start to flatten out. But when we look at the level of retail sales now, we're 35% higher than where we were at the pre-COVID levels. And even accounting for inflation and extra population, it doesn't in any way account for that 35% increase compared to the pre-COVID levels that we've had. At the end of the day, we've still got some work to do, I think, on the policy front. And let's hope that the Reserve Bank can get it right this time.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now, on the weekend, we had our slightly subdued auction markets,
Yes.
remembering that the day this video comes out will be a religious holiday in Melbourne, Cup Day, which is the race that stops the nation. So it doesn't only affect the Victorian markets, but a lot of people have taken a long weekend. So how did that affect our auction markets over the weekend, Andrew?
Well, it was given the distractions, Michael, it was a reasonably steady result. The race certainly stops Melbourne, and the Melbourne auction market was well down in terms of numbers following the previous weekend's Super Saturday, and we had big numbers the previous weekend, which we always do have in Melbourne prior to the Cup weekend. So 281 auctions in Melbourne, Michael, and a reasonably steady clearance rate, 66.1%. So the Melbourne market sort of held its own in a sense on the holiday weekend. I think Sydney was very interesting. Very big numbers of auctions in Sydney, Michael, almost a surprise, just below the previous weekend's Super Saturday result, which was the highest number in well over a year of auctions. So very big numbers of auctions in Sydney and a reasonable clearance rate, down a little bit, of course, from the previous weekend. And perhaps those higher numbers contributed to that, Michael. We know that as the auction market matures over the second part of the spring selling season, we tend to get traditionally lower clearance rates because we have more stock in the market. And that's just a seasonal impact for various reasons. So perhaps we're seeing a little bit of that in the Sydney result at the weekend, but still a reasonable outcome for most sellers at 70.6% result. Brisbane numbers were down, but its clearance rate was up. But we know that with Brisbane, it can be up and down as it has a different auction culture to particularly Melbourne and Sydney. Adelaide held its own with another 80% plus result, Michael, with slightly lower auction numbers. And Canberra bounced back with a very solid number of auctions, back at 53.8% clearance rate. In reality, that Canberra market's been perhaps a little softer over the last couple of months, and certainly doesn't appeal as being as much in favour of sellers as the other capital city markets are, particularly the Sydney market. And the trend is holding in Sydney. We can see the trend still above 70% with the first results over November, but as I mentioned, those trends tend to ease as the spring selling season moves to its conclusion through November and into December. Melbourne also has eased so far over November, down below the results of previous months. Certainly the peak of the market, Michael, of our auction markets were in late autumn and early winter, with that catch-up energy driving buyers back into the market with those value opportunities. Brisbane also down this month so far after having a weaker market through October. But we need to take those Brisbane results with a grain of salt because they do have different auction culture up there, as I mentioned before. Adelaide's still tracking above 80% on trend, where it's been for just about every month of the year so far. The Canberra market continues to report those 50%, just over 50% results that it has been reporting through the spring season, and just a little bit of a weaker market environment in Canberra that we've been tracking, Michael, for the last few months. It really hasn't reached those peaks that the Sydney market has, so some issues with that Canberra market currently as reflected in the clearance rates. Those auction clearance rates, Michael, are available on my LinkedIn account every Saturday night, the Capital City snapshots, and then on Sundays we bring forward the national report, which of course you produce through your networks, the National Capital City report, including regional breakdowns for Melbourne and Sydney. So we haven't got long to go, Michael, in our auction markets, 5 weekends until the end of the season. So it'll be interesting to see if we hold that usual trend of falling clearance rates with highest listing numbers. But at the end of the day, it's probably still a reasonably balanced market going forward.
Well, I look forward to catching up with you again next week, and let's see how the year pans out. only a couple of weeks to go, as you said, before the end of the year. Buyers are going to want to make their decisions and commitments. Similarly, sellers usually keen to finalise deals and move on by the end of the year. So there'll be likely lots of activity over the next month or so.
We've moved past the catch-up mode, and that's the point. We had a very strong market conditions through autumn and into winter. The market's dissipating. A lot of that buyer energy is dissipated because of the pent-up demand that was created last year, particularly with higher rates and the fear factor. So we're sort of normalising our markets now, Michael, and it'll be interesting to see what impact higher interest rates, when and if they occur, have on the marketplace. But we've certainly extinguished a lot of the demand, and confidence has returned to our markets. And hopefully going forward, we can have a more stable market environment in 2024. But we'll discuss that down the track.
Look forward to it. Thanks for your time, Andrew.
Thanks, Michael.